This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. Welcome to Valuing Gifts of Property, Part 4, Penalties. This is Professor Russell James. If, during an audit, a charitable gift is found to be overvalued, this will result in the need to reduce the deduction to an appropriate value and the consequent need to pay for additional taxes and any interest accrued since the due date for those taxes. In addition to this repayment and interest, there can be penalties for overvaluing a charitable gift. Those penalties depend upon the amount of the gift and the degree of overvaluation. If the gift was valued at greater than 50% of its true value, and as a result there was more than $5,000 in underpayment of tax, then the taxpayer must pay not only the taxes due, but also an additional 20% of the unpaid taxes. If in the previous case the valuation was more than double the item's true value, then the penalty would be an additional 40% of the unpaid taxes. Finally, if the misstatement of value was due to fraud, the penalty would be an additional 75% of the unpaid taxes, regardless of the amount of underpayment or the degree of overvaluation. Tax fraud can lead not only to financial penalties, but also to imprisonment. As discussed in the chapter on documenting charitable gifts, the donor is often required to obtain an appraisal in order to deduct gifts of property. Can the taxpayer avoid the penalties discussed above if the taxpayer had a qualified appraisal for the amounts reported? The answer is, it depends. There will be no taxpayer penalty if the valuation was based upon a qualified appraisal, the donor made a good faith investigation of value, and the valuation was less than double the actual value of the item. This exception would not apply if the appraisal was not a qualified appraisal based upon IRS guidelines. Even if the appraisal was a qualified appraisal, the donor is still required to have made a good faith investigation of the value of the item, besides simply relying upon the appraisal. But if both of those conditions apply and the appraised value was less than double the actual value, then no penalty will apply. However, the unpaid tax resulting from the overvaluation and any interest must still be paid. What are the penalties to the appraiser for making an excessive appraisal of an item of property gifted to a charity? If the valuation was more than 50% greater than the actual value of the item, the appraiser's penalty would be the greater of $1,000 or 10% of the tax underpayment. This penalty could be potentially catastrophic for appraisers who appraise items of extremely high value. Recognizing that such a rule would prevent even legitimate appraisers from functioning, the tax code limits the penalty for appraisers to 125% of the appraiser's fee for making the appraisal. If an appraiser charges $1,000 and values a piece of artwork at $10 million when it is actually worth only $5 million, and this error results in a $1.5 million tax underpayment, the appraiser's penalty will not be $150,000, 10% of the tax underpayment, but instead would be 125% of the appraisal fee, or $1,250. One interesting case that illustrates the sometimes unusual results from property valuation is that involving a work of art called Canyon. This work of art was inherited by the heirs of an estate. The IRS appraised the value of the artwork at $65 million and charged $29.2 million in estate taxes on the item. This valuation was based upon the IRS definition of fair market value, which is the price that property would sell for on the open market. The problem in this case is that the artwork incorporated the use of a taxidermy eagle. The sale of such taxidermy eagle feathers or parts is prohibited by federal law. Consequently, the estate was required to pay a large tax on an item that could not be legally sold. This is an interesting example of what could happen with items where the sale is restricted by law, but the valuation is based upon the price that the item would sell for on the open market. In this case, the heirs would have been much better off if the artwork had been gifted to a charity rather than inherited by them. In the final settlement, the IRS allowed the heirs to retroactively donate the artwork, treating it as if the gift had been made by the estate, thus generating no net estate taxes on the donated artwork. This has been Valuing Gifts of Property. Thanks for joining us.